Let's talk about this 50-year mortgage that's being thrown around right now. Something that I think everyone in real estate is talking about. Now, President Trump and his team have floated this idea as a way to make housing more affordable. We have longer loans, which would equal smaller payments, but depending on who you ask, it's either brilliant or a move towards a dangerous one. Now, I'm not here to talk politics. I'm here to break down the real-world impact of this. What it actually means for you if you're buying a home, developing a project, or raising capital for a BTR community. So today, I'm going to look at the good, the bad, and the ugly of this 50-year mortgage proposal. What's real, what's not, and what could it mean if it ever becomes official? Let's get into it. First, let's clear something up. The 50-year mortgage is definitely not a done deal yet. It's a proposal under review. So it's obviously largely campaigned by Trump himself and supported by some of the Federal Housing Finance Agency, or what we would call the FHFA. Now, in case you don't know what the FHFA is, think of it as the referee that oversees the big players in the housing finance, which we would call Fannie Mae and Freddie Mac. Now, these are the two institutions that buy most of the mortgages in America and make sure lenders have enough liquidity to keep making loans. So when the FHFA says something is a big deal, it really is. And its current director, Sandra Thompson, called the idea a complete game changer. So here's what's being discussed. A mortgage term stretched from 30 years to now 50. Potential monthly payment reduction on a typical, let's just call it a $400,000 home, roughly from that $2,300 down to around $2,000 at current rates. But under current law, Fannie Mae and Freddie Mac can only buy mortgages with terms up to 30 years. So for this to happen, we have to have Congress or the FHFA would have to rewrite the rules. So the good that could actually help. Let's get into that. So let's start with the good. What could make this idea actually work if it's done right? Number one, more people could buy homes. A larger loan, a lower monthly payment, that could open the door for millions of renters or first-time home buyers who have been priced out of the market. In markets like Phoenix or Dallas, where prices have jumped 40 to 60%, even locally here, Utah, over the past years, that extra $300 a month could be the difference between renting and owning. Could be. Now, number two, let's talk about developers and builders could see a boost. If more buyers can qualify, builders have more incentive to deliver new supply. That could unlock deals and keep construction pipelines active, especially in markets where, BTR and for sale homes overlap. Now, let's talk about number three. It might align better with modern lifestyles. The 30-year mortgage was designed for people that would buy a home and paid it off over a career. But today, the average homeowner stays in their house about 13 years or so. So in the sense, a 50-year loan isn't living with the debt forever. It's spreading payments over a longer horizon and freezing up cash flow. So really, in short, the good side of a 50-year mortgage is affordability, liquidity, and potential increased construction activity. It can genuinely help people get into homes who otherwise couldn't. Now for the ugly part, the parts that no one likes to talk about. Number one, homeowners staying in debt longer than they're in the workforce. If you take out a 50-year mortgage, let's call it age 30, you're paying until you're 80 years old. That means you could hit retirement still owing hundreds of thousands on your house. Number two, the potential systematic risk. To understand this, let's go back to who I mentioned earlier, the FHFA. Remember, they regulate Fannie Mae and Freddie Mac. Those institutions hold or guarantee trillions of mortgages. If we start flooding the system with 50-year paper, that's a massive shift in a risk profile. longer duration loans that are much more sensitive to rate changes. If that goes sideways, it doesn't just hurt one bank. It has a ripple through the whole financial system. So this would also include your pension funds and mortgage-backed securities, pretty much everything. So number 3, distortion in the rental market. Now, this one's important for my world that we live in every day and the developer and investor side of this. If a 50-year mortgage becomes common, it could potentially pull renters out of the BTR pool and into homeownership. That might sound like a hit to developers, but it's actually a mixed bag. If prices rise because of the new demand for BTR homes, becomes even more attractive as affordable alternatives. But if buyers flood the market and builders can't keep up, it could push land costs even higher and make development margins tighter. So either way, it changes the entire landscape. So now you got to think, if this becomes something, you'd better be running those scenarios in your pro forma from now on. Let's talk about the real impact on developers and investors. So let's boil it down. If this 50-year mortgage idea actually comes to life, here's what you need to watch. Land prices could rise and more buyers compete for limited inventory. Absorption rates for BTR could fluctuate, slightly lower demand for renters, but potentially stronger demand for affordable rental homes as for sale inventory tightens. Financing models might shift. Longer amortization means lower payments, but it could also change how lenders and investors look at debt service coverage ratios and exit timelines. And for long-term investors, this is where I sit. If inflation picks up again, being tied to a 50-year debt could be really a double-edged sword. Great for borrowers, rough for lenders. So here's my take. The 50-year mortgage could be a temporary Band-Aid for housing affordability, but it doesn't fix the root problem we have. We still don't have enough supply. If this policy moves forward, it shakes things up for buyers, builders, and investors alike. Just remember, okay, lower payments don't always mean cheaper homes, and easy credit rarely ends the way we hope. If you're developing or investing, now's the time to build models around multiple outcomes. You have to start thinking about these changes. So what if this passes? What if it doesn't? And how will it affect the market's demand curve? Now, I'm curious of your thoughts. So comment below. Do you think the 50-year mortgage helps or hurts housing in the long run? I'm interested. And if you want to see how we're positioning our BTR communities in the middle of all this, grab the case study that I have at corybonner.com/case study. And if you like this video, I made another one right here that may make all the difference in your next investment, or it may not, but you won't know until you try.